What's going on, everybody? This is a video that I did for a class in my Discord on liquidity. It's a really solid topic that you need to know. You have to understand how liquidity in the market works, and this should be the only video you ever need to understand that. So thanks for being here, and I appreciate you. And don't forget, if you like what you see, you can use my code OKNQ on Lucid Trading to get your accounts for the best deal. So actually, it wasn't being recorded, so let me start that over. We're we're doing a quick class on liquidity right now. I'm sure most of us know how liquidity works, but I have my perspective on it, and so I want to share that with you guys, and hopefully that helps you out. So, what is liquidity? Liquidity is stop orders that are resting above old swing highs and old swing lows. All right. So when you see swing highs like this, swing lows like this is liquidity. Meaning what? Meaning the market will refer back to these areas to sweep liquidity, right? Because we go from buy side to sell side. Imagine liquidity working like a game of ping pong, right? We go from buy side to sell side, buy side to sell side, buy side to sell side, right? Now, it's not always perfectly like that, obviously, but it is if you change time frames. Okay, so we got external liquidity, and then within the external liquidity, there will be internal liquidity. Oops. So for me, I usually just label my external liquidities as my higher time frames, right? And then my internal liquidities will be lower time frame. So an example of that would be for external, right? Probably 15-minute or above. So for my external liquidity, I'm going to be using the 15-minute or above. Is it right to say that lower time frame external liquidities is basically higher time frame internal liquidities? Interesting. I would say it just depends on where we're actually at in reference to higher time frame liquidity points. Like if we have this 1 hour up here, right? There's going to be a lot of lower time frame liquidity in this rundown. So basically, but once we get down here, we look to the left, we have this swing low. Once we sweep this, now we're having external that becomes internal. It becomes so the way I see it, we always are going from external to internal, internal to external. So no matter how you're looking at it, let me think of this question. Lower time frame external liquidity is basically higher time frame internal liquidities. Bro, I'm stumped by that question actually. Lower time frame external liquidity is basically, I guess I'm confused on that because I always see lower time frame as my internal. Maybe that's why I'm so like 15-minute, 5-minute or below will be my internal liquidity always. Because we don't execute on the higher time frame, right? We use higher time frame as a way of direction or delivery or bias, but we enter our trades on the lower time frame, right? So for me, the internal liquidity will always just be relevant to lower time frame, if that makes sense. Because when I'm zoomed out on anything 15-minute or above, all of these swing highs and swing lows, I'm going to view them as external because they're higher time frame. So then our internal liquidity, right, is 5-minute or lower. So this is where Let me see. Let me find a good example. Okay, so now this is where it gets interesting because let me go back here. Now, this is why it's important to view different time frames, right? Because it's not as simple as here we have external liquidity, right? Here we have external. Here we have external. And also here we have external. So we have both these stacked lows right here, right? But we didn't sweep this external before we went up to sweep this one, right? Well, how'd that work then? Because probably on 15-minute, right? On our 15-minute, we still have external here, right? But if you're putting it in reference to this low, you could just not call this internal, or call this internal, not external, because it's within a 1 hour. But for me, this is still an external low being swept, right? So when, a lot of times everyone in the chat is like, oh my God, bro, I'm waiting for this low to get swept before I long, right? Like I guarantee somewhere in here, we were probably like, okay, not the time of day we'd be trading, but just for an example, I'm sure somewhere in here, all of us would be like, oh, dude, I want this low swept before we long. Can anyone agree with that? Like if we're looking at price doing this, right? We zoom out, we're all going to be going, okay, we want longs after this low is swept, right? But we don't get that, right? We don't sweep this low before we come up to sweep the hourly high. Why? Because we swept a different external low that we put in. Does that make sense? So that's why you have to check multiple time frames. If we don't have an hourly sweep, we might have a 15-minute sweep. We might have a 30-minute sweep. And that would be good enough to label as your external sweep. So then when you get your external sweep, what do? We zoom in time frames to look for what? If we have an external sweep on sell side, I'm going to zoom into my zoom into lower time frame to look for what? Internal. No. Yes, sir. I'm going to look for internal buy side to target, right? Because now we have an external sweep. So if we have an external sweep on sell side, what does that tell me would be next? The next thing we would target would be, wait, why is this going so slow? The next thing we would target would be this internal buy side. So we've swept external sell side. Now I want to look for internal buy side. So we look to target a setup. See, now we get our internal buy side run. Holy moly. So, does that make sense? So we might not have swept the hourly low, but we still got an external sweep. So now we can look for our setup to go the other direction. What'd we get? External sweep here. Delivery from this gap here like that. Right? So now we can look at our checklist and find everything that we can use as a confluence to get a trade. And you can be confident in that because of the way liquidity works between external and internal. So now we have two external lows down here, right, on the hourly. We come up, sweep this external high. Now what can you expect? Now that we just swept an external high. Now what? It's the same as down here. We sweep an external low. I need to make a template for external, dang it. Internal, right. So we sweep an external high. What do we got to go after next? An internal low. So once we sweep the hourly high, that's why all of us start zooming in time frames. And sometimes, yes, it can be external to external. But I will say this, right? What do you see anything here in this run that could be an external swing low on a lower time frame? Right. So because I'll tell you what, I almost guarantee that this wick right here that created this FEG on a lower time frame is probably a swing low, right? And there it is. So here's our swing low right here that's still on an external time frame because it's 15-minute and above. So just because we swept external buy side doesn't mean now we have to come all the way down here to sweep external sell side. So this is what I think you're talking about external to external, because now we come down here, sweep the 15-minute low somewhere, sweep the 15-minute low, right? So now we have what? Even though it's not on the hourly chart, it's not way up here in a way super obvious one. What do we still have? A sweep on external sell side. So we have our external buy side sweep here. We come down, we have another external sell side sweep here. So now at this point, we don't have to come all the way down for these lows. This can be somewhere we turn around because this is still an external liquidity sweep. Even though it's not on the 1 hour, it's still 15-minute or higher. So we sweep that 15-minute low, and then look, we go for buy side again, I think. Yeah, so we sweep buy side again, right? So now we sweep buy side again. Boom. Then what do I do? We have another external buy side sweep. What can I expect to go for next? Oh, that was a data candle. But here we have 5-minute internal liquidity. Right? So boom. So it's literally just, it's nothing but a back and forth game of finding internal to external. So that's why the first thing I like to do is like, okay, on the 1 hour time frame, 30-minute time frame, do we have external, right? But if I see these lows down here and we're way up here, I'm not going to use these as my target, right? Even though we did sweep external buy side, I'm not going to use these as my target, right? I'm going to use the 1 hour sweep, but then I'm going to zoom in on the 5-minute or lower to try and find internal, which here, tons of it, right? So now we have internal. Oops. So boom. Now we can watch and see, do we get a sweep on internal after sweeping external buy side? So we sweep external buy side, come down, sweep internal sell side. What does that mean? Well, that we can go for buy side next if that's what market wants to do. Right? So it's literally just internal to external, external to internal over and over. So yeah. And that's why our setups work the way they do, right? Because we wait for an external sweep. Here we swept two 30-minute external lows. Then we zoom in time frames to something lower and find, okay, do we get a setup? If we do get a setup, do we have what? Internal liquidity to target, right? So we sweep external, we target internal. We sweep external, we target internal. It's not always external to external in one shot. Sometimes we back and forth between the two, between internal and external. So I guess that's, that's why it's so important to alternate time frames, because you really need to see where we're reacting from or to, right? Look, here's another example. Let's see. So here we have this 15-minute external low, right? How many of us, if we're wanting to long, would be waiting for this hourly low sweep, especially when we get here, right? Well, we don't get it and we still pump. Let's see. Zoom lower. What do we have? Well, now we have internal that we swept here. Right? So don't always marry the external. If you're marrying the external and waiting for it to get hit and it's not, it's okay to change time frames to try and find something else. Just it has to be an obvious swing high or swing low. If we're waiting for the hourly sweep all damn day and don't get it, but then we don't bother checking other time frames, right? And then we're like, oh, we never got the sweep. I can't long. But then well, we swept a 15-minute low. We swept a 5-minute low. You know what I'm saying? So, and that's why I like using for my setup checklist, that's why I like sweeps on 5-minute time frame more than lower, because they're more significant. It's more significant of a sweep, right? So if we get the sweep on this obvious 5-minute low that delivered out of this big candle, right? So this 5-minute swing low is inside this 5-minute gap that sent price higher. So now this is a significant swing low inside of a significant gap. So now this is enough of confluence for me, because we have our delivery, we have a 5-minute sweep, right? And then if we do get a setup, then that works for me. Obviously, this is not a good example, but the logic behind it is the same. So yeah, use 5-minute and above for your liquidity sweeps, and you'll take better entries. Trust. Especially if it's a swing low that has once delivered out of a fair value gap already. But yeah, I think that's gonna do it. And I'll see you guys tomorrow. Sound good? Later.